Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, waiting on Dimitri, I'm going to stop the share. Here he is. Good morning, D.
Hey, good morning, Will. How are you?
How you doing, buddy?
Pretty good. A little bit sick today. Um, took
Yeah,
a
no,
cold Tylenol, I think.
it's
Uh,
going around.
yeah, everybody's sick here. Good morning, everyone. I'm going to share my screen here, and today we will cover the SPY, how to find the SPY implied volatility skew. Um, But before we do that, let's just take a look at a couple things here. Um, what happened yesterday in the markets, SPY. So we see that there was a 3% decline yesterday in SPY, which is pretty significant decline in the market for 1 day drop. And it did follow a Fed, Fed decision, Fed interest rate decision. And if we just look at the chart over here, this is what happened yesterday. It kind of looked stable. And after the Fed decision, you could see that the price just dropped and volume increased significantly. So before we look at and that might, give us a somewhat idea of, well, what does the skew look like in a situation like this? Because we had this big move in the stock market with high volume. Implied volatility was up. We see that there was a lot of option trading over here. So to the right hand side, this shows us the implied volatility in this solid line, and then these bars that are stacked, the yellows, the call volume, the blues, the put volume, and these bars are showing 5-minute volume bars throughout the day. And we could see here that the volume significantly increased right after the Fed announcement. That correlated also with a big spike in implied volatility. So let's take a look. So before we look at the skew, and the skew's measuring, how did the out of the money options behave in this scenario? So we see that at the money implied volatility was up significantly, but what about the difference in the implied volatilities between the out of the money puts and out of the money calls? How did that look like yesterday? And before I get into that, let's just take a look what SPY tended to do the day after the Fed meeting. And in this situation, also the day after such a big drop in the stock price. Okay. Because those are two things that happened yesterday. There were kind of two events, when one's the Fed meeting, one is that there's this big 3% drop in the stock market. So I'm going to go here to the tools, and we're going to go under events. Okay, so we're going to click events, and we have this drop down menu to select from. If I go here, these are price events, so largest 1 day losses, 1 day gains, and the FOMC meetings, and so forth. So let's take a look at the FOMC meeting. So if we click on FOMC meeting and hit reload report, what we see here is a historical table of what the Fed meetings and what the stock did the day of, the day after, leading up to it. So you could see here, this is before the event. So leading up to it, 2 weeks, 1 week, 3 days, 2 days, 1 day. This is the day of the event. So this would have been equivalent to like yesterday. So if we expand that, we have, what the stock did on the day from the previous day's close, the opening gap, the open to the high of the day, the open to the low of the day, and from the open to the close. And these are, all the historical Fed meetings for last 12 meetings. So looking at this, we could see that, the day of the move, 58% of the time it was up, 42% lower, close to 50-50 on average, break even. What did it do the next day? So the day after the Fed meeting, that would be this one. So that would measure from the close of yesterday to the close of today. So you could see here that it tended to be up more often than down. So 73% of the time, the stock was higher the next day, 27% lower for an average gain of 0.3%. However, there was this unusual move here of down 3% that we don't see in these observations. So let's go to the events, back up to the events. And by the way, we could look at the option strategies as well. So these are the different option strategies and how they behaved around the FOMC meetings. So if we did, we could pick a date range here, like say 1 day after, day of event to 1 day after, rerun it. And then we have, how did the 25 delta call perform? How did the at the money call perform? The straddle, at the money put, 25 delta put, and what the stock did. So it's another way, if we wanted to look at the skew, we could reference those 25 delta options. Okay. But I'm going to look at a skew from a different perspective than this. Before we do that, let's look at the largest 1 day losses in the last 12. So we're going to just go back into our database and show, the largest 12 day losses in the last year. We're going to reload that. And let's go back to the stock price. So here you could see yesterday, that was 3%. Got one August 5th, 2.9, September 13th. Oh, sorry, this is going back more than a year. This is going back to 2022. So these, you could see yesterday's, falls in that range, an average down 3.4%. So here, the next day move shows something a little bit different, that it's more often it goes down 55%, almost 50-50, but this shows, negative return of 0.4%, 50-50. So we have these two different events that happen. Keep in mind, one, it tended to go up after the Fed meeting, but yesterday was an unusually high move or big move to the downside. And history shows that next day's move is closer to 50-50 up or down, a little slightly more down than higher. So keeping that in mind, let's now look at what the skew looked like yesterday, where we compared the out of the money calls to the out of the money puts, and how did they move, and what do they look like in relationship to each other? Is one higher than the other, one lower than the other? Are they equal in implied volatility terms? So we're going to go under options, and let's use our single leg dashboard. So I'm going to go here, and on this single leg dashboard, we talked about it a couple times, where we look at the option volume from the perspective of just single leg trades, buying call or put. It takes away the volume for the multi-leg trades, contingent trades, and get all these statistics on it over here. But we did end up going to the table below, and we talked about this particular table. It lists all the different options expirations, and then gives us statistics about each of those options expirations. So when we look at skew, well, which option expiration do we reference? There are different options expirations, and of course, different option expirations could have different implied volatilities and different skew, and something in one expiration could have happened where there's more volume and movement in the skew than in a different expiration. So we could standardize it kind of like the IV30, but this allows us to look at it more granular and look at the actual option expirations. So we could open up this table just to see all the available ones. So you could see, there are a lot of different option expirations available to trade in SPY. They go all the way out to January 15, 2027. And for each of these expirations, here's the at-the-money implied volatility, which are different. And then we have this skew, which measures what the implied volatility is for an out-of-the-money put. So we're looking at a 25 delta put here, and an out-of-the-money call, 25 delta call. And then we compare that implied volatility to the at-the-money. So that's what we're doing. We're saying, okay, if we ran a straight skew, so let's pick an expiration year, like December 27th. So traded 151,000 contracts, 6 days to go. And we could pick anyone, but let's just stay on this one. Well, the at-the-money implied volatility yesterday was 15.1. And if we took 15.1 and we said, okay, if we plugged in the option pricing model 15.1 and create a theoretical value for every strike, right? So we could take the option pricing model, look at each strike, each call, each put, and use that implied volatility as our input, and we come up with this theoretical price and a delta. And then we ran a straight skew, and then we found the 25 delta put, and then we found the 25 delta call, the actual one. And we said, okay, what's the difference between the implied volatility of 15.4 and the 25 delta put? And we show the percentage difference. So this is saying that the 25 delta put implied volatility is 19% higher than that the money is. And the 25 delta call is 12% lower than that the money IB. So this shows us that the skew looks like it's increasing to the upside, increasing as to the downside, right? As the strikes go down, and the implied volatility is decreasing as you move up in strikes to the 25 delta call. So that's what this. So we could kind of get a sense from those two numbers what the skew looks like. But that's just showing us the skew. The next question is, how did it change from the day before? So that's what it looks like, given that picture. But did the skew stay the same? Did it increase or decrease to the wings? Did it get did it get steeper? Did it flatten? Like, what happened there? So we need a change, right? We need to see how they changed from the previous day. Well, let's assume, how do we measure that? Well, we need to find the strikes that we're referencing, right? So this is, this is a certain strike, this is going to be a certain strike, and this is going to be a certain strike. So we have to find the strikes that we're referencing, check what the implied volatility was the day before to what it is now, and get the change. Just like a stock price, right? Where did the stock price close yesterday? Where is it now? And then what was the change in the implied volatility? So in this case, the at the money implied volatility was up 27.9%. The put implied volatility was up 10.9%, and the call implied volatility was up 31%. So even though the skew, right, looks like it's to the downside, right? The premium is to the downside. The relative change was that the calls look like they increased by a bigger percentage. Okay, so the calls, it all jumped. The whole line jumped, right? At the monies went up. The 25 delta puts went up. The 25 delta calls went up. So the whole line went up, but it looks like it went up a little bit higher towards the calls. So let's see how that looks. So if I click on this December 27th, I'm gonna let me just make this table smaller. We get this new table below, and you could expand it here. Let's just expand it a little bit. Okay, and what this shows us is the December 27th expiration, and we see the trading volume in the bars. So there's some pretty decent amount of trading in this expiration. The yellow bars show us the amount of contracts traded by each strike in the calls. The blue stack on the same strike is how much volume traded in the puts. So a lot of trading in the call volume here. And where did we end up yesterday? Around 585, around here, 586. You can see most of the trading was, above where we are now. So how did this line shift? So the day before, it's this solid gray. That's this solid gray line. It cuts off at the 20 delta, something like that. So that, and then the new line is this solid, black line with the dots. So the green dots mean that the implied volatility is higher than yesterday. If it was lower, it'd be red dots. Obviously, this line is higher, right? So there's a big shift from the day before to the next day. You could see the gap. There's a difference, right? There's space in between them. The new line is higher than the old line. And visually, you could kind of tell, like, yes, it went up, but there's more space here to the upside. So you can see that the skew, even though downs, as you go lower in strikes, right? As you go down in strikes, the implied volatility is still skewed higher. Implied volatility keeps moving higher and higher as you go down in strikes, implying that if we go down, the volatility will accelerate. But we also noticed that the way the line shifted was it also looks like that this upside, but the upside increased by a bigger percentage. Right? The space between these are higher than these. Okay, so there's a decent demand for upside call volume over here in this expiration. So if we wanted to go down even further and analyze, let's say, this call. So this 605 strike, there's a lot of call volume in there, and I'm hovering over it for volume weighted average price traded at $2.28. So this is looking at all the single leg call option volume yesterday, and there's on average traded $2.28 volume weighted average price. So if we click on it, okay, it's going to load up the data for that option. So we got to wait a little bit because it's loading a lot of data, but let's just see. So the stock closed at 586.28. and we were looking at the which strike was that again? 605. Okay, so this is the 605 strike. And we get all this analytics stuff over here. Okay, so this is the top. These are the total number of contracts that traded in here. This is the delta, the total delta value of all the options, the total gamma, vega, and theta. And this is a breakdown, our interpretation of the single leg options that came in as bought order flow versus sell order flow. So 56% of the order flow our model estimate were incoming buy orders, 44% sell orders, and this is a breakdown by order size type: small retail order type, proficient, and large trader. So you could see that there's participation, all types of traders. It looks like SPY is a popular stock to trade, and all types of traders participated in there. This is a pie chart showing that the proficient traders, larger traders, made up almost 34% of the volume. Institutional traders, 24%. If we go down, this is the bought versus sold, 56% versus 44%. And this is the number of contracts in each. So this would be represented up here. Just to speed this up, I'm going to kind of come down here, and we get this sometimes, looking at a chart, price chart of the of that option. So here we have two charts to look at. One, it's shown on the day. The trading volume in the call, and it's looking at the trading volume and looking at the implied volatility that the option traded at. Okay. Another chart is looking at the price. So when we look at an option, the option price could be changing for different factors, decay, and it could be changing because of implied volatility, could be changing because the delta, the stock is moving. So to get a different benchmark on the relative value, we could look at the implied volatility. And here, this chart over here looks at the implied volatility, which helps us get a better sense of like the theoretical or fair value in terms of IV. From here, from 9:30 to the end of the day, it shows us the volume traded, and these bars here show us 5-minute volume bars. The green is stacked where we interpret it as an incoming buy order versus red incoming red order. Okay, so that's how we interpreted these order flows. This solid line here, that's shown the implied volatility of that option's midpoint. So as the option is moving, we're looking tracking the midpoint, and this solid line is showing the traded implied volatility, the VWAP traded implied volatility. So you could see that it's been trading. This one's pretty active, traded pretty much, all day. And this is where the volume weighted average implied volatility trades. This one next to it shows us the actual traded price. So you got a lot of information here just to go down deeper right to the option level. But I'm going to stop, I think, right there, because we kind of went already pretty deep into that analysis.
Well, that was awesome. The great use of the Chameleon and its tools. Everyone, thanks for joining us today. Please remember to like this show and to follow and subscribe if you're new, and don't follow and subscribe our YouTube channel. With that, D, great job. You have a great day, and everyone be safe today.
Thanks, everyone. Stay safe out there. Have a great trading day.
Trade in peace.